Previously, we've talked about owning stock, and when we talk about owning stock, that is simply saying I have ownership of the company. Maybe a small percentage, maybe a big percentage. Now, that's about us owning stock. But we also talked about the fact that we raise money. And we raise money by either giving our money, which we will automatically call that equity. We can borrow some money from a bank or create a bond and get money that way, and that's through a long-term liability. But we can also issue stock to others, meaning that we can issue a little bit of our ownership to other people. Now, when you issue ownership to other people, they're expecting something in return, right? And you should if you're investing your money. That's why you invest to get something in return. One way you can get something in return is like this right here. Let's say that I have an investment and I say that if you give me $100, I'll give you $130 back by the end of the week. That's a good investment, right? I mean, you can probably find better. You may can't, but that to me is a pretty good investment I would go for. And so for that, I understand that I am looking for what you call appreciation of the stock. I'm looking for the stock itself, the ownership to raise in value, okay? Now, the other side is this right here. And by the way, if you do that, understand there's always risk involved, right? So risk is involved whenever you invest in anything, especially with something that is startup, whether it's a startup company. If you're investing in a new program for yourself, new exercise program, there's a risk that you might can't finish it or that something go wrong with you. So any investment is going to always have some kind of risk involved, okay? Now, if you get with something more stable or a company more stable, then in general what you're going to have is not a lot of appreciation in terms of the stock going up. Not to say that it can't go up, and definitely not to say it can't fall. But in general, you're not going to depend on making money from that stock going up. What would you make money on? Well, that's where dividends come in, okay? So when we think about paying dividends, we are now taking money from outside people and we are giving them ownership, and we are considering our company to be stable, okay? And they're going to need a return investment because they're not going to be able to make the $30 off of the $100 that we did. So we need to give them some type of payment. Now, let's understand how this works from an accounting standpoint so that we can understand what we always look at, which is assets, liabilities, and equity. We're going to start by going over this exercise here, and then we're going to do the journal entries. By going over this exercise first, it will make the journal entries a little bit easier for us to comprehend, especially if we've never done it before. So let's just pull up a company here of February 18th. Shareholders of record on this date will receive a dividend of $30 per share. Additionally, the ex-dividend date is February 18th. What does all mean? Well, the main thing that we look and see is, hey, there's a dividend payment coming up March 3rd. Now, for an investor, they're saying, oh, they're going to invest in our company, they're paying dividends March 3rd. Okay, good. They're paying dividends March 3rd. Now, one thing that an investor needs to know is that if they're going to get our dividend that we're giving out, look, we're considering ourselves to be at March City. I apologize. The one thing an investor needs to understand is that they need to have ownership in our stock, in our company, as of a certain date, okay? So, when it's saying that the dividend date is scheduled for March the 3rd with a record date of February 18th, then on February 18th, they have to have owned shares. One thing I forgot to mention is that this announcement went out March the 9th, okay? Let's click on it here, you'll see that there. This announcement actually went out March the 9th, okay? So, and it's not letting me get there, but it's March the 9th when this announcement went out. So on March the 9th, or February 9th, excuse me, February 9th, then February 9th, we said that we're going to pay dividends on March the 3rd. On February 9th, we said we were going to pay dividends on March the 3rd. Also on February 9th, we said that you have to own the stock by February 18th. That will be the date of record. Now, why is that important? Because we're talking about our company, right? Let's just flip it around and say that we're all going to invest in something. And we may invest in things at different times. You get your check now, you may get a refund. I may get something extra. We're going to get out, but as soon as we get it, we're going to get in. Now, if you invest in my company, I got to keep up with all y'all, right? So I need some type of date to cut it off. That's why we have this date of record. No matter when you get your money in, as long as you buy that stock by February 18th, that's your due date. Your due date is then in order for you to get your grade back on March the 3rd. Your investment in that stock must be done, in this case here, by February 18th, so that you can actually get the dividends so that I can know where you are, I can know where to find you. I'm probably exaggerating with know where you are, know where to find you, because a lot of us electronic. But it helps to make us understand that, look, some way we have to be able to figure out where everyone is and who has ownership so that we can pay them, okay? So this announcement was February the 9th. It doesn't show it here, but it was on February the 9th that they said that they were going to pay dividends on March the 3rd if you own stock by February 18th. February 18th is the date of record that you must have purchased the stock, okay? And it simply says right here, the ex-dividend date is, which is the last day to purchase stock, to purchase shares, that's stock, to be eligible for a dividend. So this is something that real life that actually happened. These dates will change from year to year, so it's not going to be the same now, but this is just the one date that we use for this one, okay? So just kind of how it works, if you're going to buy stock, if your friend tells you, hey, I know a stock, they pay really good dividends, just make sure that you buy the stock as of that particular date, okay? So that you can be eligible for that one. Otherwise, you just have to wait till the next time they pay dividends, okay? So you just missed that one, but if it's a really good dividend paying stock, then you'll be okay in the future. So does that make sense in terms of how this works just overall? Okay. All right, so let's see how we account for it. Remember, all we do in accounting is we're categorizing things to help us to understand the story when we're not there. Remember now, we're business owners, and we don't have time to do this stuff. So we're depending on what someone gives us to make sure that we can tell what's going on with our business. To make sure we know what they're doing, that's why we're looking at these things for ourselves, okay? And once we know how to do them ourselves, then we can trust someone else. So let's understand the impact this has on our financial statements. As usual, it's going to go back to the balance sheet. Remember, income statement flows to retained earnings flows to the balance sheet, especially the equity section. We're in the equity section a lot right now, okay? We're still going to use some other stuff, but we're mostly in the equity section. So we want to understand the impact of dividends, especially on the equity section, but in the event that they touch other parts of the balance sheet, we want to know those as well, okay? So let's begin. We're going to flip back and forth between these two. We're going to do some journal entries in just a second. Remember, this announcement happened on February 9th, okay? On February 9th, they said that you must own stock by February 18th to get a dividend on March 9th. Now, the day that they declared a cash dividend, that was declared on February the 9th, okay? So the date that they declared the dividend, the date that we said we're going to pay a dividend, what did that do to assets? If we're going to pay a cash dividend, we say on February 9th we're going to pay the cash dividend. Have we paid cash out yet? So it has no impact, or as we see here, no effect on assets, okay? Now, we did say we're going to pay this on February the 9th. We said on February 9th that we will pay this. Though we haven't paid it, we've now made ourselves lots of people because we're saying we're going to do it. People are going to go start doing whatever they can to get in our business because our business is good, right? And they're going to get in there on February 18th, so they're making plans to do something we said that we're going to do. So do you agree we created a liability? Okay, so since we did, then on that date, on February 9th in this example, our liabilities increased by whatever the amount was for that cash dividend. We haven't paid anything yet, so it doesn't affect assets. Okay, but we have said that we're going to do this. Now, it's also going to have an impact on our cash dividend, as we will see with our journal entries in just a second. Our stockholders' equity, when we're saying we're going to give ownership, so we're going to give up some of our ownership. So if we give up some of it, then the other part has, what we give up has to balance out. So it's going to go down. So we're going to have a decrease in stockholders' equity when we say it. We're going to pay this on February 9th. So if you want to write February 9th in this example, or you can use any example you want to, you can go to your favorite company. If you or your friends or parents or working place have some, go there as well, okay? And then you can see some different examples of that. Now, February the 9th, we declared the cash dividend, right? That's what we have here. Now, we're going to pay the cash dividend on when? March the 3rd. So we see how we get there. We're going to pay this out on March the 3rd. What does this look like in terms of our assets, liabilities, and equity? When we pay it out, we agree that we're going to credit cash because we're actually giving out money. So that makes sense, right, from our company standpoint. Are we okay with that? So when we say we're going to do it, We hadn't done any money yet. But now that we're actually going to pay the cash dividend, we're going to decrease our assets with the debit. Okay? Everybody good so far? All right. Now, also, you remember back when we said we were going to pay this dividend on March the 9th, on February the 9th, we actually declared the dividend. We created a liability because we said we were going to do that. Once you pay your debt, do you have an increase in liabilities or a decrease? Once you pay your debt, do you still owe those people whatever it is? So that means you're going to decrease your liabilities. Whatever journal entry you put here, you're going to remove it and you're going to decrease your liabilities. Okay? Now, for stockholders' equity, we only have to touch this one time. Once we declare it, we set it aside, and that's it. So once we actually pay the cash dividend, then it's not going to affect our stockholders' equity because we already took care of that up here. Okay? It's important to keep in mind we're talking about cash dividends because we want to switch to another type right now. So these are cash dividends we just talked about. What is a stock dividend? Instead of paying in cash, you pay with issuing additional stock. Okay? So once again, why are we doing this? The investor wants something in return. It's not a hard, steady, fast rule, but in general, if you are a newer company, you're trying to put all your funds back in to grow the company. So in general, you will not pay dividends. And that means that the investor is really taking a risk that your stock is going to go from here to here to here, and that's where they're going to get their return. But usually, not to say it's all the case all the time, but usually for a more established company, we're going to say that, look, we'll pay you dividends because we're not reinvesting. Obviously, we know that these car companies are still trying to do stuff, but the level of growth has probably decreased to the fact where they're going to say, we're going to pay dividends. We can pay you a cash dividend or we can pay you a stock dividend. We just talked about cash dividends. Now we're going to talk about what happens when we pay a stock dividend. And we're going to do that by comparing. So remember now, this announcement here is for a cash dividend. We're also going to use this and pretend that we also did a stock dividend on the same day. It doesn't talk about it, but we're going to pretend that we did a stock dividend on this same day. So on February 9th, we know that we had a cash dividend and we said we were going to pay, and we also declared a stock dividend. In either case, have we given away anything at all? So there's no decrease in assets. Keep in mind, a stock dividend has nothing to do with cash assets, it has nothing to do with assets at all. But in either case, if you're comparing the two, just because you declared it does not mean you have does not mean that you actually giving cash out. Okay, so it has no effect on the assets. Now, this is a stock dividend. The difference between a stock dividend and a cash dividend is that does not actually increase our liability. We're giving away part of our equity. Okay, now yes, when we say we're going to do it, we better do it. But if you think about that side of the balance sheet, all we're really doing is just switching the type of ownership that we have. So in this case, we do not have an additional liability. So a stock dividend, we have a company and we say, you know what? We want to treat our investors right and we're going to give them stock dividends because that's what's best for our business right now. And it does not affect our liabilities. But if we did a cash dividend, it would increase our liability. Now, what else about the stock dividend? It doesn't even affect stockholders' equity. Okay? It doesn't affect stockholders' equity. It may affect the composition of it, but it does not affect the stockholders' equity at all. Okay? This is a stock dividend when it was declared. Now, we know that we're going to have to settle. Yes, ma'am. I'm sorry.
Is the reasoning behind with the stock dividend, it doesn't affect anything, is because it would just be as if you were using something that you already have versus like using the promise to spend something that.
It is using exactly what you have. Remember, if we say that you and I have a business, right? And let's make it your business because it's probably going to be even better. You have 100% ownership in your business, right? If you start offering a stock dividend, you are giving up something that you have. Now, obviously, the cash in your business is yours as well now. But in this case, you have something that you are giving away. So since you're not giving away cash, it's not even relevant in terms of asset, which is kind of what you said. we have not really created a liability because a liability has nothing to do with the equity part. We're pretty much going to switch a composition up, which means if you look at the title, which I did not emphasize this, the total stockholders' equity does not change. Your ownership position is going to change. You're going to give up part of your ownership, 1%, 5%, 0.0001%. That's going to change now. I mean, so it is something that you already have. It will affect stockholders' equity, but the total, there's not going to be an increase or decrease in the net total. Whatever you had at first is not going to change. So yes, you're not giving up cash, and you don't owe that to anyone. But once again, when we start saying we're going to do this, we do have to do it. So we want to keep that in mind. And by the way, anytime we start declaring dividends, whatever you start, you kind of have to keep it up. Does that help you out there?
So instead of this is my cash, instead of me giving you something, I'm just going to give you cash because only one person can own the cash at a time.
Right.
It's basically, I'll just use a printer. This printer, it used to just be mine, but now it's our printer.
Yeah, it is. I mean, it's only this much of my printer, if I only bought this much of it, but yeah, that is actually part of my printer now. Which means that when we talked the other day about different varying levels of ownership, let's take that printer. If half of it is my printer and half of it is your printer, then, this is just an exaggerated thing, then if I say you can't use it, you can't use it, right? But now, if I only own this much of that printer, I may own the label on that printer. So I can say all I want to, but all I really have probably rights to is the label. That's an exaggerated example, but what I'm giving you the example of is you can have significant influence. Even if I own 20% of the printer, if I steal 20% of the printer, I've damaged the printer. If I steal the label off of it, you still have a printer, right? So in that case, significant influence, watch how much you give out. Even if you are still making a ton of money on it, still watch out because you don't want someone to come in and have significant influence, and now that ton of money you're making, it could possibly be ruined. So if you give it out, there's nothing wrong with giving out equity in your company. We just want to make sure that we are aware of the significant influence, which it's not covered, in great depth here, but that's called significant influence usually when it's 20%, 20 to 40%, and if you're 50-50, now you're looking at equity, a lot of equity, and the accounting rules really change after that. So that I would give that printer example, 20%. If I damage it, but if I just take the label off, that's like mostly what we own of most businesses, so most big businesses. So always be aware. And did that help you out? Okay, good, excellent question to put that in perspective. All right, now we're comparing cash dividends, the payment of cash, with stock dividends, which is something that we actually already own and stuff. When we declare the stock dividend, it did not affect anything there, okay? And guess what? It still doesn't affect anything in terms of our total assets, total liabilities, and total equity right here. So there are journal entries now because it does involve some shifting. But in terms of affecting things, no, there is no effect on these in total. So this helps us out when we think about journal. Well, it helps us out in terms of understanding our business better. But in terms of this class, it just helps us to understand, okay, let me check and see, do I even need a journal entry for this? No, I'm not have to waste my time on that. So in general, these are some things that kind of help us out. Or at least when we do them, we will understand that at the end of my stock dividends, there should be no change in total stockholders' equity, no change in total assets or anything like that. Now, the last thing we're going to look at is a stock split. A stock split is no type of dividend at all. It's not a dividend at all. If you think, what is a company, if you think of, it's not going on now, but if you think of a company like Tesla, you remember when Tesla first came out, they were like growing, right? I don't know how high they got, but their prices were growing. Let's just say that their prices were, I don't know, I can't remember, but let's say their prices were $1,500 per share. Who in here right now could buy let's put it in perspective. If that was true 10 years ago, when you were the age you were 10 years ago, did you have $1,500 to go buy a share of Tesla stock? No. But what if somebody says, you know what, we need more investors. So even though you were the age you were 10 years ago, we're going to cut the stock price down to, I'm just saying, let's say $150 per share. You probably could have bought a share of stock for $150, right? That is what you call a stock split, where you change the amount, and let's look at it right here before I talk about it. In particular, the stock split has no impact on stockholders' equity. This is exactly kind of what you're talking about in a different way. A stock split has no impact on stockholders' equity. If I own a share of $1,500, if I own one share of $1,500 stock back then, if I bought it for $1,500 for one stock, then that company, and I bought it from you, your company still had $1,500. If you said that you wanted to slash the prices or cut it in half by 10, divide by 10, that's what a 3-for-1 is, divided by 3. To go from 1,500 down to 150, you issued a 10-for-1 stock. Had you done that so that other people can buy your stock, then I still would have owned $1,500 worth of your stock. Okay? It's just that my stock would have been worth less. That's the wrong word. It would not have been as high in value per share, but everything I own is still $1,500 in your company, right? So usually it's done, that stock is getting so high people can't afford it. But in order to keep on getting new investors, it's not going to affect me. But I think if you could have gotten in back then, if this was the whole world in here, if this place was the whole world, and I own $1,500 share and no one else could get it, then how can they raise capital? You can't get together. Maybe you can get together and buy it, divide it up and buy, about however many people in here, but each of you could have individually bought one and the company could have had more. So a stock split takes the price of the stock and splits it by whatever it is. If it's a 3-for-1 and it was $1,000, if it was 3-for-1, it was $1,500, then it's going to split it 3-for-1. Where a share is not worth $1,500, it is now worth $500, and now more people can get in and buy it. If it's a 3-for-1, if it's a 10-for-1, like what I talked about, it was worth $1,500 at first, then we slashed it by 10%, we divided it by 10 to get a 10-for-1 stock split, and now more people can buy it. But at the moment of the split, the stock split here, the value, the stockholders' equity did not change. If I went from $1,500 for one share to whatever it is divided by, I still have $1,500 as a result of that stock split in there. It's just each individual share was less. So stock splits do not affect anything at all. Neither do stock dividends, but the reason for the stock split, I want us to understand that it's just saying that the value is not changing at all. Your total investment value is not changing at all. Okay? Does that help us out in terms of just understanding what we're talking about with dividends? Okay, and let's remember now we have 3 major dates. The day we say we're going to do it, April 23rd. We're saying we're going to pay dividends on April 23rd. We're saying we're going to pay them on Mother's Day, as long as you own it by the week of finals. So there's always a cutoff date to make sure that everyone is there. If we say we're going to do a stock split, then it's not going to affect anything, as you see here. That doesn't mean we're not going to have journal entries, as we'll see, but it means there's no effect on it at all, okay? So we're going to do some journal entries now, but hopefully this has helped us so that when we get started, it's not like just, writing down stuff. We don't want to walk around being a calculator. We want to be able to understand what we're doing so that when we get to that point, we can actually go and help others as well, okay? So now let's try to do a couple of journal entries here. Let's start. On January 1st, this company here has 61,100 shares of no par common stock issued and outstanding, okay? The stock has a stated value of $4 per share. Remember from the other day, whenever you record that stated value, then it's just recorded at whatever it is, okay? The actual common stock is recorded at whatever it is, all right? So I'm just gonna write this for a second. It's not going to be anything that you need for this example, but it's kind of just a brief review, okay? Let's just say that this happened all at once. It's not part of the problem, but let's say that we issued 61,100 shares with a stated value of $4 per share. This is just for example now, okay? If you issue think it was 61,100 shares. We're going to say at a stated value, of $4 per share. Then we're going to have a journal entry of debit cash, and we're going to credit, I'm going to abbreviate common stock, CS common stock, for 61,000 times $4 per share, and I don't have that computation, so 61,100. Let me move this over so you can see it a little bit better here. We'll debit the cash, and we'll credit common stock stated value, that's SB stated value, at $4 times 61,100, okay? This would have been the journal entry for a stated value stock, okay? If we issued all that at one time. Now, obviously, these happen over time, but if that was a problem given to you, that would have been a journal entry. Just a quick review, okay? Now, if it was issued, stated value that was issued, shares issued this with a stated value, if we did it for $5 per share, then this would change to $5 per share. This was still, the common stock is still at the stated value. If it was at par, it's still at that amount, but then we would have something called paid in capital in excess of stated value, okay? And that difference would have been $1 times whatever we had right there, okay? So that would have been the difference, all right? It's just making sure that we understand that when stock is issued, it's always issued at par value, or in this case, stated value. No matter what these numbers say, okay? It's always going to be issued at stated value, or in this case, at par value, but in this case, it's issued at stated value. The paid in capital, by writing it this way, we see the difference between the two, okay? So that's just a little quick review in terms of how we got there. Now remember, there were so many journal entries that's not likely to have been one, but that's usually the way our problems are given to us, all right? Now, let's talk about our transactions that we have. On April the 1st, we're going to issue 9,900 additional shares of common stock at $11 per share, okay? At $11 per share. Now, we've gone from stated values, and now we're going to go to something a little bit different, okay? What we're going to do is we're not going to do all the journal entries, but we're going to have to keep up with these, okay? So let's keep up with what we have. On January 1, we had 61,100, okay? 61,100 shares, okay? And on April the 1st, we're going to issue an additional 9,900 shares. On June the 15th, we're going to declare a dividend. June 15th, we're going to declare a dividend, okay? This is the date, this is the declaration date. Now, in this case, we're only talking about cash dividends, but this is what we're going to pay out, okay? Now, on July the 10th, we're actually going to pay the dividend. And by the way, this is at $1.70 per share. $1.70 per share, okay? On July the 10th, we're actually going to pay that. We're going to pay the $1.07 dividend per share. Okay, so let's just kind of stop right there for just a second, all right? So we started off with 61,100 shares. Now we're going to issue an additional 9,900 shares. How many total shares do we have at this point in time that are going to be outstanding? And what we do is, this is the time, this is the date we declare dividends. So we need a total of all this. How much is that total right there? 71,000 shares, okay? Now, the correct terminology, which we don't have right here, is this is called stock that is issued, keyword, and outstanding, okay? Issued and outstanding, meaning that, remember we talked the other day about treasury, buying some of our stock back? That is still issued, but it's not outstanding. When we bought that stock back now, it was issued, but what think of outstanding is out there with everybody else, okay? That stock, when we bought treasury stock, that was back in our realm, in our hands. So that's not outstanding. So the key is that we only pay dividends what's issued outstanding. Think about it this way. Can you pay dividends to yourself? No, you have other forms of payment, but you can't pay dividends to yourself. So that stock, treasury stock, is issued but not outstanding, okay? So we have 71,000 shares of issued and outstanding stock, and we're going to pay dividends of $1.70 per share. So what do I do? To get my dividend amount, to compute the dividend amount, I'm going to multiply my shares. It is issued, so I'm just going to emphasize outstanding times the amount per share. Times the amount per share, all right? In this case, that is 71,100 shares. 71,000 shares. That is at $1.70 per share. $71,000 at $1.50 per share. How much will that be? $106,500, okay? So this is going to be the amount of my liability. It is only through July, even though we have all these different dates now, it's only through the amount of time that we have. So we know that we're going to pay these dividends out. Let's explain what's going on here, okay? We're going to debit cash dividends, okay? Because this is what we're actually paying. The journal entry let's use this color here. The journal entry will be for a debit to cash dividends, okay? But when we talk about how does it affect liability, go back to our chart we just had, this next account here will be a liability, which is dividends payable. And note, this is a liability, okay? That account there is a liability, this one right here. All right, so this is what we have. Now, that is to record at declaration date, okay? So let's say at declaration date. Declaration date is, as we, with our example earlier, February 9th, we said we're going to do it later on when we declared it. Then this shows that we established that liability that we just talked about, okay? So that's that date. Now, when we actually pay it, that means we're going to actually distribute some cash, right? We agree because it is a cash dividend. What else happens on that date we pay it? Okay, we don't see the date they paid it yet. When we actually pay it, what would that journal entry be? We know we're going to pay cash, so we're going to credit cash. But what else have we done? We had a liability, right? Have we gotten rid of that liability on the day we paid it? We haven't. We said we're going to pay them on a certain date, okay? When we actually pay it, we're going to give the cash away, right? Okay, yeah, there we go. That's good, okay?
I thought you were saying it was one of those declared.
Gotcha. Okay, yeah. Now this one here would be the declare. Is that the declaration date? That's the declaration date there. On the journal entry for the payment date, I'm putting a little space here for a reason. But not. Yeah, I have enough space there. The journal entry on the payment date is we're going to credit cash because we are reducing the assets. That makes sense, right? We're actually reducing it on that date. But we're also going to take this account here and we're going to decrease this liability because we no longer owe it on this payment date. Okay, so dividends payable is the one. Dividends payable. Why is this? Because we no longer owe this particular dividend, okay? We no longer owe that particular dividend. We'll have another one later on, okay? But on the payment date, we no longer owe that amount, okay? That amount that we have, okay? So we have a journal entry for the declaration date. And a journal entry for the payment date, all right? There's one other journal entry that we haven't talked about yet, and I say journal entry we haven't talked about because you'll see, I'm just want to say that is for the date of declaration. For the date of record. What does the date of record do? The date of record says that February 9th, declaration date, or just go back to the other example, February 9th, declaration date, we said that we're going to declare dividend to be paid on this particular date for people on record. What will we have a journal entry right here? What's the purpose of this? The date of record. The date of record is to say that I know you and you and you and not you and not you and not you on stock. Okay? So that now since I know that, I can know who and where to pay it to. So for the date of record, there is no journal entry. No journal entry, okay? For the date of record, no journal entry ever, okay? Everybody good with that part? All right. Now, on June 15th, I believe that I gave you something a little bit different. Let me read this again for just a second. I think I misspoke a second ago. Let's double check. I'm missing some shares. I have 61,100 shares here. Plus that is the 90,000, okay? Oh, I'm sorry. I gave you 150. I should have given you 170. I apologize. That should have been 170. I wrote 150 there. This should have been 170 right here. Let's change this from 150 to 170, okay? Sorry about that there. I put that in red. Mark my paper wrong. Can you give me a new total, please? I'm sorry about that. $120,700. Now I put it in red so that we can know that that was something that changed, but I'm going to try to make it so we can know this is related to our journal entries, okay? All right, now, once we understand all of this, all we have to do is just plug in the numbers, all right? So let's make sure we plug them in correctly so I don't say the wrong ones again. It's clearly only going to be for these two. There is no journal entry for the date of record. Sometimes a multiple choice will have this on here and ask you about this, but just know, and this is more so especially if you're going to be in accounting or finance or something like that, there is no journal entry on the date of record, okay? That's not here for us right now, but this is what we have here. All we have to do now is just put this number into our journal entries, okay? And the other one as well. I should give me more space here. $120,700, $120,700 goes right there, and then here, $120,700, $120,700. Okay. So those journal entries are hopefully fairly simple. Is that, and of course you got to take time and probably do a couple of them, but does it make sense where we are right now? Okay. Understand the flow of it. What we see is this is what was given to us in our books. Okay. We started off at the beginning of the period, the beginning of the year, 61,100 shares. Then someone purchased some more. Okay. So on this particular day, as you see, and by the way, we're thinking of this as doing this at the end of the year. Okay. So we know what's going to happen at the end of the year. We know that we're going to have some more stuff going on, right? But at this date, we stop and say, this is how many I have, okay? This is how many I have, and I'm going to declare it on this day. On this day, I need to know that this is still good, that, basically what people are, so I can make sure they are getting it, okay? We don't say send the checks to it, but, because most of it's going to be online in most cases, but we still have to know who owns it on the date of record, and there is no date. Then all we do is we pay it out, reducing our assets, going back to our chart we had earlier, and we have a dividends payable that we are going to reverse when we pay that part right there, okay?
So typically it's always going to be, whenever you're paying for the cash, it's always going to be a dividends payable, but whenever it's a declaration, it's going to be debit, credited.
Yeah.
Because you still have the cash dividends, so that's why.
Yes, because I still have that. I still have the cash right here, okay? I still have the cash, so I owe it. I need to make sure I keep it in this pocket over here and don't put it in my spending pocket. You see what I'm saying? So it's just a way for me to just make sure that I put that cash in the right place. So this is where I established my liability right here, okay? And it is the credit right there. I'm gonna put credit, that's credit. And that same one is a debit, okay? All right. So that's what's going on. Now, all we're going to do is just continue going throughout the year, all right? So that's as of that date. And on December the 1st, we issued an additional 4,400. Okay? So an additional 4,400 means that I do what now? I'm going to have to go back and compute what I have outstanding. So I take my 7,100, and on December the 1st, there are 4,400 more outstanding. And on December 15th, I declare cash dividend to stockholders on record as of December 31st. What do I have to do on this particular date? Obviously, I'm declaring the dividend. And I also established my date of record. So which one of these needs a journal entry? The declared dividend date, the fact that I declared the dividend, or the fact that I established the record? Which one needs a journal entry? Think about what happens. When I declare a dividend, has it affected my assets? Has it affected my liabilities? Remember we said that I got to keep it in this pocket over here so I don't accidentally put it in my spending pocket? So I have a liability I'm already declaring this right here. I have a liability. The date of record just says, I'm telling you that on December 31st, according to the problem here, you will have to have stock. There is no journal entry for the date of record, okay? So journal entry, no date of record. Only when you declare a dividend and pay that cash dividend, do we have that journal entry, okay?
It's basically writing down a bill you gotta pay.
Say again?
It's basically writing down a bill you've gotta pay.
That's it. Just like anything else. Just like you pay any accounts payable, like we pay our bill liability. Let's remember one thing, which I haven't said this time, but dividends are not an expense, okay? Now, it is just like anything else we have to pay. There is no denying it. We have to pay it. It's just that the dividends, remember, come out of our statement of retained earnings, where we had our beginning retained earnings plus our income less dividends. And so that means that it's coming out of here. Okay, so it's not an expense. Expenses come out of your income, dividends come out of the beginning of retained earnings. But like you said, it's like write down a bill we have to pay. It's just write it down. As long as we remember that, and you don't have to know it right now, but as long as we remember that, we'll be okay. Okay? But yes, it's just like any other bill we have to pay. So now, I have 7,100 shares plus 4,400. What's my new total that I'm going to have to pay? In terms of the amount of shares outstanding, how many shares will I be paying dividends on?
Would be 75,400.
75,400. Okay, 75,400 shares that I have to pay on. Okay. Now, this problem doesn't ask this, right? But what if? This is just an if. Let's just say, what if we buy back 1,000 shares? I know you can't read that sideways, but what if we buy back 1,000 shares? Then we would have to reduce the amount of shares outstanding. So what we would do is take this amount and subtract that $1,000. Because remember, this is treasury stock. That's treasury stock. No dividends are paid on treasury stock. Okay? So if we were asked that question, or if we were given that information, then yes, we have to add this, but then if we buy some back, we don't pay ourselves dividends, right? So we have to take that off of the books. All right, so that's a what if type of question. Okay. Now, knowing this right here, 75,400, and we are paying it at $2.20 per share. So 75,400 times that right there would give us what? $75,400 times 200 times $2.20 per share.
165,880.
165,880. Now, all we do to show it doesn't matter when the date is. That's why I like to recycle these, because it shows us the journal entries are the same. The amounts may change. Okay, so at this point in time, all we do is we have our cash dividend declared in this case, so that we can have a link here. Let me see if I can do it this way. This is going to go for December. For December, I will have my 165,880 debited and 165,880 credited. The main things, the reason I'm putting it here is to show that the journal entries do not change. The amounts may change based on how many shares are outstanding, meaning that they're not included treasury stocks in these, but this never changes. It also shows that the purpose is still to establish the liability. Okay, it still establishes liability. It has to be owned by December 31st. Do we need a journal entry for that date? That date is called the date of record, so no journal entry for that. Now, we're not paying this out this year, right? But when are we paying it? We're going to pay it next year, and let's see if they don't go that far, but whenever we pay it, which is next year, all we're going to do once again is just reduce the liability. This is not part of that problem, okay? But whenever they pay it, you're still going to reduce that liability, and you're still, at that time, going to pay out your cash, okay? So that's not part of the question. It only stops right here. So that's just to show what will happen sometime next year, all right? And in general, that is our cash dividend. That's our cash dividend. Key things to remember. You do not pay dividends on treasury stock. This is stock that's issued and outstanding, our regular stock. You only pay dividends on stock that is issued and outstanding. You don't pay dividends to yourself. Another thing, dividends do not come out of income. There is no journal entry for the date of record. This just says, hey, I know where you are. For that, we're not talking about this right now, but there is no journal entry for the stock split. It's just talking about a difference in what it was, a difference in the composition, okay? There is no journal entry. If you literally, I don't know the time that they do it, but every time that company does it, if they say they're going to do a stock split at 2:07 p.m. today, you can just watch your account and refresh it at 2:07:01, and it will just have the same amount of stuff, just shifting the price, okay, and the amount that's outstanding, okay? And your journal entry, no matter when it is going to be the same for your cash dividend that is paid. And this carries with you throughout whenever you're studying those journal entries, okay? Now, you may have to do a bit more complex. They may say, hey, we're going to have more journal entries where you have to keep track of more things. But as you see, as long as you're keeping track, they can have 30 entries in here. As long as you're keeping track, you're going to be fine, okay? I say that for your upper level classes, should you choose to take those, okay? So it's not too much that's going to go right there in terms of new stuff, all right? All right, so the next journal entry on this company is pretty much the same, okay? They have 7,300 shares of stock outstanding. They declare a $4 per share cash dividend. If you take your 7,300 times 4, we're going to get that same amount, okay? Not the same amount. We're going to get 7,300 times 4 And this is how they get to this amount here, okay? This one is actually a little bit easier than the previous one, but it's just showing us that, look, these are the journal entries that are the same. Doesn't matter what it is. Now, what I would like to say is that even if they had some stock that had additional paid-in capital when it was actually distributed at first, it doesn't matter what the par value is at that time. It doesn't matter how much it's sold for. The only thing that matters when you pay dividends is how much you're paying for that dividend. It only matters that you are only paying on stock that is outstanding, and that you are making sure that you have only that stock outstanding and no treasury stock. That's all that really matters at that point in time. Okay. So this one is just like that. And our final thing that we'll have is, of course, just being able to prepare that stockholders' equity sheet. So there's not a lot here that is really going to be difficult. All right. This is the one we did the other day when we talked about issuing the stock, and I will go over that again. I'm going to erase half of the board, but I'm going to make sure that we have what we talked about the other day one more time. I don't usually use this side for liabilities and equity, but I do want us to just have this again to make sure we know this, okay? If you have liabilities or equity, or equity doesn't matter, the purpose is to raise capital, is to raise money, okay? That's the purpose. So you're going to, no matter which one we issue, debit cash, period. Debit cash, no matter which one we issue, because we're raising money, right? When it comes to our credits, if it's for a liability, or it's for an equity, and liability, let's talk about the bond. If it's for a bond, credit, bond payable at par, always. Okay, always. The similar concept, similarly, you're going to credit stock at par always, no matter if you sell it for more or for less, okay? You're always going to have those. They're always going to look the same, okay? And then the additional paid-in capital goes to, when we're talking about stock, or the additional paid-in capital goes for, the discounted premium goes to basically, if we have a difference in market value versus the face value, okay? So these, we don't ever want to mix the cash. It's only going to be for whatever the cash is, okay? The bond payable, always credit at par. Look for that number at par every time. The best one to study is the one we did the other day where we went in and corrected the exercises, okay? We were given some incorrect numbers on purpose, and we had to go in and find out what was wrong with them. The best way to approach that is to say, let me write this journal entry down because I know this journal entry, and then I'll look to see where they are wrong, okay? That's going to be the best way to think about that. Any multiple choice type of question, of course. But even on these right here, if you have a place to go and find the answer at first, or the drop-down menu of an account, always guess at what, you'll probably know it, so you don't have to worry about knowing, but if you don't know it, guess first before you go looking for it, okay? And then the difference always goes to the paid-in capital. If we're talking about stock, and if we're talking about bonds, it's going to go to that other one, okay? Any questions on that right there? So this is ownership. This is talking about ownership, okay? And we talked about ownership in general, but these are just some general notes for liabilities or equity, okay? General notes. General notes for liability or equity. Everybody good? Well, that's good. Everybody have a good weekend, which hopefully starts today, right? Let's make the weekend start today.